Hello there. My name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to today's recap. So what is today? Today is Wednesday, and another down day. So, you know, the connecting of the dots that we've been trying to do for everyone in the markets, depending on whatever your time frame is, has been somewhat, you know, playing out a little bit textbook style. Now, obviously, you read a textbook, it's very easy to read. You know, but to navigate the textbook, or that's even a horrendous analogy, just, you know, sometimes it's easier to write and talk about it versus actually do it with some of the intraday gyrations. So, you know, I know for me, I tried something a little different because I know sometimes, you know, I'm being in front of the computer all day as a trader as well as, you know, the strategist and you know, the guy that tries to be the offensive coordinator besides a player in the field. I said, you know what I'm going to do? You know, last week when I said, you know, I think we see 161 in the spiders before we see new highs. This is what I'm going to do. I'm going to actually, you know, buy puts. Okay, so this way I don't touch them, I don't overtrade them, and then when we get to certain spots, create a put spread to help finance them, and then that'll be my way of trading around them. So if you remember last week, I was like, you know what, gun to head, I think we see 161 before we see new highs. We were trading around 165, 166, and then to me, I wanted to navigate what I thought was, you know, this overall wedge pivot pattern in order to have it confirm, you know, what my gun-to-head thesis was, which is just a way of saying that if you had to make a call, which we don't have to do because we can navigate the market when it's happening, but sometimes it's good to make a call so people could be, you know, ready for it or see if their thesis combines with it and then, you know, make some kind of strategy and forward-looking plan ahead of it. So, you know, if you go right here real quickly to the SPX, this is what I was looking at. All right, first of all, look at the trend here since November. It's been a very gradual trend that was tested once right here, okay, at the 50-day. And then, you know, you had this accelerated trend that pretty much got broke right around here, okay, which we talked about right around, what was that, 1640-ish, okay? A few things transpired along the way that we tried to talk about to help everyone navigate. First of all, you know, you look at past patterns in order to figure out future composure. So if you come back to me, what has happened here, you know, in all of 2013 has been no commitment to the sell side. We talk about no commitment to the buy side, but for these 5 months, it's been no commitment to the sell side. Every time we've had a mini break, so to speak, in the markets, the bears never contained any type of bounce back. The bulls just penetrated through levels, and then we rested, and then we continued. So that's what we were looking for this time around. So you go back to the chart of the SPX, you will see, you know, remember we talked about this one. Okay, I like to follow trends that follow the 8-day and 21-day moving average. And if you look, remember right here, after we started the year with this wide range, you know, nice igniting move above this downtrend from the end of last year, we held the 8-day, and this was a really nice spot to be in a portfolio approach. So what happened here? Quickly, boom. You know, broke the 8 and 21-day, wide range bar, and then we held in there. And then on the low, we actually engulfed, okay, this down move and then held higher and continued. So if the bears had any control here, they would not have let us go back through there. So PS, or fast forward, same thing happened here. This was that push through failure where, you know, just say right around here, if you did get to some cash on an intermediate basis and you got back involved in the positions there, it was, you know, pretty, we were able to stay with it all the way up and it pushed through here. This was the excitement that got sold. So if you intermediate trader said, okay, now I'm going to get back to cash, see if I could be net short, see if we have a big correction. That's what took place. But what happened? We held the 50-day. From here, question was, would we bounce back and then go lower, or would we penetrate through an area the bears had to defend? And we penetrated through. Then what did we do? We held higher, so this was your spot to re-put on some positions if you took them off here, and then we continued. Okay, so now fast forward, during this last part of the trend, that was definitely frustrating because anytime you start to be up 15, 16, 70% in the S&P, not even a half year, you know, half a year in, you definitely get a little risk averse. I know I do. So anyway, here's where, you know, we broke through the highs. This was your outside day. So if you go back to our blog, you go back to Twitter, you know, we talked about this outside day saying now, you know, it's a time to potentially take some risk off, sell some loose positions, think maybe net short, okay? And then the day after, remember, you had that move to the 21-day. The first part of the process was, okay, do we hold the 21-day, which we did. And then the next part of the process was building the wedge. Look at that. Lower high, higher low, lower high, and then boom. Okay, so this was your wedge break on, just say, Friday. Okay, so here is your wedge break. Then you had a Monday small red dog reversal. Okay, and I remember people on the Twitter feed saying, you know what, look back here when that happened. That happened the same thing. This little red dog reversal happened here. And then the next day, we blew through the engulfing bar. So that said, okay, bears have no control. So what happened here that was different? Okay, yesterday, if you remember, we were stronger. We tested the apex, and then we closed weaker. And what was that on? That was on, one of those Tuesdays, the Tuesday streak. So gave you some signs that we were not ready to just continue to go up. And then, boom, what happened today? We took out, we talked about 1622 in the S&P. I said, would we be able to press if you came in net short? Some guys did. I had a little tricky time with the spiders pressing it. I probably should have done better, but I didn't. But, right around here is where I said I'm going to sell some more of my, puts to create the spread, because, I figured that we would come in and bounce around here. So I'm still in the put spread. I still have some straight up puts left, so I was able to hold, because unfortunately, being short, I'm not good at it. So right in here is where I think, right around this day is when I started putting on, I think I bought my first set of puts before the spread, and then in here is where I created the spread, and now, I was able to hold through, 1655 or 1660 all the way down to 1610. So for me, that was a bit of a growing process, because, during portfolio approach, when we're hugging the 8 and 21 day, for me, I like to hold 8, 10 positions, trade around them. I'm a better bull than a bear. So I'm like, let me take advantage of this process. How can I do it? And I was able to do it with the put spread. Next time, hopefully I'll be able to do it with size across the board with a lot of things short besides, just the indices. But that's part of the learning curve. Everyone has different strengths they play to. Typically mine is in an up tape, But then I kind of know when we're going to get into the down tape where I pull back, take risk off, but I also want to be able to maneuver the risk off environment for potential profit. Everyone knows that I like trading Apple, and Apple went from 700 all the way down. I didn't really get caught in it, but I was playing those bounces with small paper cuts, and finally we had those 3 different bounces for like 20 to 30 points. I made good money there, but I should have been a better shorting those bounces versus trying to be a surgeon to take out what was there. But that's, again, part of the process of learning. So anyway, you go back to the chart of the S&P, and here was your break. So with that said, look where we are. We're right above the 50-day. So, kind of kidding around, I said today, I go, you know what's going to happen? Either we're going to stop in front of the 50-day because people are waiting to buy it, or it looks like it's going up a little bit right now, or it's going to come through and people are going to think it's not valid and then think that they got involved too early and then come back to it. So with that said, we'll see what happens tomorrow. I don't think you need to be in a full-out rush, but right here, this is where we are. So I chose to take my spiders off, so I'm not short the spiders overnight like I was last night, but I still have, I would say 90% of my, the puts that I had are in a put spread. And now I have actually maybe 80%, and I still have some left over if we, have a down day tomorrow or whatnot. But I'm actually looking to be a buyer. So we talked about how do you find the red dog reversal, in this tape. Okay. Now, if you come to me, the reason why I like a red dog reversal is because it's not a cost average way into a trend. A lot of people who tried to short the whole way up, and cost average into their shorts, they wind up taking so much pain that they probably get stopped out and they lose their solvency and they don't stay with it because they're not doing a level versus a level. When you pull back, it's the same thing. You don't know exactly where we're going to stop going down. So what happens typically is people say, like today, so to speak, go back to the S&P. If, just say you said, I'm going to get long the S&P versus today's low. Today's low is 1607. So if it opened up at 1610 and you took it home long, and said, I'm going to give it to 1607, okay? Then all of a sudden it breaks 1607, you say, I'm out of it. So, if you have to, in order to go lower, you have to continue through a prior day low. But then just say you were to sell it here, and then it went down, and then held the 50-day and came back above, then you would say, okay, I could be a buyer at this 1607. My stop now is just, say, 1603 or 1600. So you have a 4-handle risk-reward relationship on something that just came in from the highs of 1687. So you're talking about 80 handles that, your risk reward for a counter trend move. Who knows if it's exactly going to happen that way, but the reason why it's such a good action area because A, your risk is defined, and B, Now, some people say, you know what? I don't think it's going to be a 5% correction. I don't think that this 50-day is going to hold. This thing's going to the 200-day. This thing's going to at least to test, 1576. So in order to get to 1576, what does it have to do? It's got to trade through today's low, 1607, for that to happen. So if we opened up a little bit tomorrow, they would be shorting it through the low. So that's why this turns into the pivot point or the action area. So the question is, who's right? The guy that thinks the 50-day is going to hold, or the guy that thinks that we're going to retest this 1590, this 1598, which was the last prior breakout. So you don't know. But what you do know is if we make a low, come back off the low, trade back through the prior low, then you could buy it with that as your stop. Okay, and the same thing goes for all these other sectors. You look at the XLF. Today the XLF played some catch up to the downside. We talked about in order for the market to be pressured, the financials are going to have to roll over. So those who were trading the financials saying, I think the 21-day is going to hold, they just got stopped out. So with that being said, you had a decent short move. I know that Vicky and Chart Girl, who, congratulations, had a great day today, shorted Goldman and some of the others. So now, what do you know? Some people say the XLF's going to get to the 50-day, which it might. But in order to get there, if we opened up tomorrow, we'll have to get through today's low, which is 1972. So that's why it's your pivot. So it might come below, come back above, and you might say, I don't think it gets to the 50-day because if the stock market or the spiders bounce off the 50-day, this is your relative strength, so it should hold above it. So that's why you use this as your pivot. Using a stock, it's the same thing with Goldman. Goldman just broke this upper area, okay, and or actually it's still above this trend line, but it broke this upper area. And now the question is, where does it go down to? Could it go down to 155? Maybe. Could it go down all the way back down to test the 50-day here? Who knows? But either way, if you use the prior day low as a pivot, you could be shorted once it goes through if you think it's going to 155, but then if it reverses up, you switch. Now in something like the XHB, it's a little different, right? This group is acting weaker. Okay, this group, I tried buying it a little bit today. It didn't work. I tried to do the exact same thing I just talked about, where it went through the low of 29.79, put in a low, and came back above. And I'm like, okay, maybe this is going to be a buyable opportunity, but it turned into a choppy mess. Okay, this, is already showing relative weakness. This is below the 8, the 21. It's already pierced the 50, and now is on a pretty big trend line that it's held a few times. So tomorrow, you know what? I'll try it again. And maybe tomorrow will be the day the trade happens. But if the spiders don't hold the 50-day, this could see a move to 28-ish. It could see a move almost maybe, who knows, to the 200-day, because look at some of the stocks in this group. Toll Brothers already through the 200-day. I tried that today too. It didn't work. I said, okay, I'll try it again tomorrow. Lennar through the 200-day. Also, if you think about, some of these groups that are already below the 50, near the 200, it's tricky going after those because those are not where the leadership is. Yeah, you could play a bounce, but if the market doesn't stop there, these are the groups that are going to go even further because they're weaker than the overall S&P. And one of those, like look at the IYR. I know it's had a heck of a move to the downside, and this has been one heck of a move to the downside. This trend broke here. Look at this wide range, crazy engulfing day. That's why you take notice on an outside day to take notice like this, because you never know where it's going to lead to, but you don't have to, again, if you respect this day. If you rode this trend and respected this day, you fully stayed out of the way of what went on here. And if you also chose to use red dog reversals along the way, you wouldn't have got caught because every time it made a new low, it continued and you never saw that reversal. So now it's through the 200-day. I know today, I was talking about maybe trying it, but I'm like, you know what? If the market doesn't hold, this thing can continue lower. This could maybe even test the gap. So now what we'll do is we'll use our 200-day moving average as the rule. Like if it goes below it and doesn't come back above it within like 2 or 3 sessions at most, it's going to continue to get institutional selling because this is just, there's no bounce here. So anyway, tomorrow we'll see if we can get a calculated red dog reversal if it were to trade through 67.21 and come back above it. Perhaps we get some type of trade here and then a retracement back to the 8-day because this is definitely very extended. But it's going to have to do a red dog reversal. It's going to have to, reclaim the 200-day, and this has been very weak. IYT also, look at this trend line. This broke a pretty important trend line. It's held it a few different times. So this is already below the 50-day. It's already showing you relative weakness. But I guess if you got out here or you got out there, you have the luxury of tactically trying to trade it. Hopefully you made some money short there. I haven't been really touching it. So maybe tomorrow, you'll see if it could, use 109.35, same type of thing. People who are like, oh, look at this, it's so weak. It broke the 50-day. It could get to here. It can get to this support here, or it can get to the 200-day. In order to do so, it's going to have to trade through today's low. So depending on how we open tomorrow, if we open up, people who think there's going to be follow-through selling will probably sell it through the low. And if all of a sudden we regroup and it doesn't want to go all the way down there and the market holds the 50-day or whatnot, then you get maybe a red dog reversal. And you could buy it here with the stop at whatever that low is tomorrow. And then you see if maybe you get a trade to retest this trend line, but overall this is weaker. So when you're in this corrective phase environment, you don't know. So in my head, do I think we hold the 50-day, or do I think we at least hold somewhere down to like that 1576? I do. I think 5 to 7% correction, why not? Same way I said gun, I'm not doing the whole gun to head thing. The gun to head thing made sense last week or a week and a half ago when I was like, you know what? I'm seeing some relative weakness across the board. We were very extended. I know the time frame, blah, blah, blah. Now, I'm going to be doing a level versus a level, and I'll try something tactically. And then if it creates more than just a tactic, I'll stay with it. Like, just say Japan. Japan put in a hammer bottom on Monday, went long it, and then Tuesday we had a gap up. I sold 75%, and I said, I will trail the rest, trim and trail, because who knows, maybe 16% was enough, but it wasn't. So you look at the EWJ, and I got out of it because I just, I'm going to wait. This was the reversal right here. First of all, here was your, outside day to get away from this after an enormous trend. Here was your little hammer bottom after filling the gap. So I said, I'll get long some. It's a nice tactical play. Got a gap up into resistance, sold 3/4. And then on the last quarter, I pretty much sold it where I bought it because I'm like, you know what? I'm just going to wait and see. And now we'll see what happens here. Some people thought 10% was enough. Some people thought 15%. Who knows? Now we're down 18% off the highs. Maybe it has to see the 200-day. We'll see. So I'm just going to wait. So in this kind of environment, on that outside day on May 22nd, which I think you got to write down and look at that tactic and look at that pattern because it repeats itself. That's what you finally could have seen to switch some gears, something potent enough. And then obviously a few of the other steps you went over. Now I went back to tactical, taking cash flow trades, trying to be net short. Couldn't really do it so well with the spiders. I did it better with the options because I didn't have to maneuver it. And actually it was kind of cute where I had the puts first and then on the down move created the spread. But anyway, that's a step, that's a learning process or something that is good for me because I hardly make good money shorting stocks. I'm usually better on the buy side, but I'm not a perma bull. I'm a perma setup man, and I'm trying to make sure that I learn new setups and learn new tactics and feel comfortable going with them. So anyway, we'll see what happens. We kid around on Twitter. Today, I said, I sent a tweet that I said then and said, we were 13 cents away. Does this mean I'm wrong? If it doesn't happen tomorrow, do shots go off? But it's just kind of cool that you can time the market, you can use feel, you can use calculations, and then you could trade around it once the market confirms it. If the market doesn't confirm it, you don't do anything, your plan was wrong. But if the market confirms it, at least you had the plan in place, and then you have to execute on it. And we all know once your plan is fulfilled, you look back and see how you executed on it. Did you do well or didn't you? And that's when you truly analyze it. So the next time you put a plan together and the market confirms it, you perform better. So this way you're not as frustrated. And that's it. So anyway, we know we have jobs report, big jobs Friday. It seems like good news now is not that good news, and bad news now means the Fed has done so much and it's not, doing what they say it's going to do. So I think the glass has been half empty, but once I think we get that red dog reversal, or that pivot bottom or the hammer bottom or that outside day bottom, then maybe, it'll turn back into, glass half full. So we'll figure it out. But again, you don't have to know if you're in a good position. And if you cleaned up loose longs a week or so ago, you got net short, you said, I'm going to sit back and wait. We could be down 5% off the high, 7, 10, 12, 15. No one truly knows. And you hear everyone making all the big guesses. But you know what? The market will tell us. We'll have different spots, and we'll figure out whether or not the spot is valid and worthy of you applying some of your hard-earned money and investing capital in order to make some returns. It's been Scott Redler, T3 Live, the recap. See you tomorrow morning. Have a good night.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.